Hey everybody, welcome back to Layman Loans. In this video, we're going to see what is a revenue projection. So first of all, you have to know what is the revenue. Then we'll see what is a revenue projection. The revenue is the total income what you get out of business based on selling of product or services through that business. So that includes your net profit or loss as well. So assume you have a product. So let us consider multiple cases. So assume you run a fruit shop and every day you buy about 300 kgs of fruits. There is a cost for buying those fruits and you mark a certain profit for each of the fruit on per kg basis and then you sell it at a profit. So assume you buy stock for your fruit shop for about 5,000 rupees per day and you mark a price which is about 50% more than your actual cost price. So you want to sell all the fruits for 7,500 rupees. But per day you are selling only fruits worth 4,000 rupees. So put together you are actually making a sale of 4,000 rupees. So in total what happens is you're buying stock whenever it is over. So your cost price becomes 5,000. Your total markup price becomes 7,500. But per day your actual sales is 4,000 rupees. So over a period of 30 days, whenever stocks are over, you go and purchase stock. Like this, throughout the month, the total stock what you have purchased is about, let's presume about 1 lakh. And you made a total sale of 2.5 lakhs. But still you have a lot of stock left in your garage as well. But end to end, you have made a purchase of 1 lakh and sold for say 2.5 lakhs. So the net profit what you have got is 1.5 lakhs. Technically, this is the gross profit. The net profit is after you deduct your salaries, your like shop rents and all the other miscellaneous expenses what you have to reduce all those. Finally, the amount what you arrive at after deducting all the expenses is considered to be your net profit. So now let us know what is a revenue. Whatever amount you sell throughout the month or throughout the year, the total amount inclusive of all your cost price and all the other expenses as well, the net amount what you receive from a customer is considered to be the revenue. So what is a projected revenue? Projected revenue is basically a revenue which currently does not exist, but you are trying to showcase to somebody. It can be an IT department, it can be IT meaning not information technology, IT means income tax. So income tax department or the bank with reference to how much you are going to get as revenue in future with reference to the benchmarks what you have set in the current trend. So why is it important and how is it going to be beneficial to you? So in this channel called Layman Loans, we help you get new loans. So assume you want to build a house, like currently you have a ground floor constructed, you are living in that house and you want to build another 2 floors, first floor and second floor, and rent it out to people. So let's assume you have a total income of 50,000 rupees per month and you have enough loans to meet. Say you have a personal loan, a credit card loan and a home loan, and all these EMIs eat about 30 to 32,000 rupees of your income, and remaining 18,000 is what you have with which you are running your family. Now you have the goal to actually construct another 2 floors in your home and you are trying to go and ask money to the bank. So first of all, what the bank will say is, currently you have 50,000 in income and you are meeting about 32,000 rupees in EMI. So if I am giving you another 1 crore loan in order to actually build 2 floors in your home, possibly you will have to pay about 80 to 90,000 rupees in EMI. You currently don't have that income, then how are we likely be able to recover the entire loan what we give you? So outrightly they are going to reject that. But if you are able to provide a revenue projection that, let us assume you give me the 1 crore loan, in every floor I will be able to build 3 portions of 2 BHK apartment, and in total I'll be able to build 2 floors. So about 6 portions of 2 BHK apartments, and in my region I get a regular monthly income of 18 to 20,000 rupees per month as a rent for my particular location for a 2 BHK. So let us assume I build 6 such portions, and even if 5 portions are occupied, I'll easily be able to make about 1 lakh in revenue from the new construction. So if you provide me the loan, maybe the construction time is going to be for 3 to 6 months time. During those times, I'll be able to meet up the pre-EMI, and as I keep constructing over a period of next 3 to 6 months time, the entire construction will be over, and after which I'll be able to get a rental income of additional 1 lakh from my house, and I'll be able to meet my EMI through that. After the EMIs are met for a period of 15 to 20 years, the house becomes my lifetime asset and my loan is also over. So by this way, you are actually giving a revenue projection to the bank, stating that what is going to be your likely increase in revenue when you give this particular bank loan to them. So how these funds are going to be utilized, and because of which, what is the total income which is going to be generated in order to increase the total revenue for you. This is one of the most important data every banker looks at, and their decision to actually lend you is completely dependent on your repayment capacity as well as the property value. So let's see what are the things a bank considers when they are lending money, say for a home loan or for loan against property. Firstly, they'll see the property value. So if you're going to take a home loan for a place where literally the rental values are hardly anything, like per month people get only 3 to 5,000 rupees in rental income, but still you are saying you're going to get 20-30,000, then typically your case will be rejected, because that is not the actual rental value for the location. So there will be checks and balances done from the legal team of the bank in order to know whether the real rental value in that location is so much or not. And secondly, your property value should support your entire loan. So if you are able to build multiple apartments, then the overall value of your property should substantially increase, and because of which the overall resale value or the total value of the property will increase. Third most important parameter is your repayment capacity. The bank's methodology is, I give you money, you give the money back with interest. That's all. Banks are not really interested in always liquidating your property or selling your property to take the money, because that's a very long and painful process. So for that very reason, they want to ensure for every single customer they lend money, they are always there in a position to pay back the loans on time. So your repayment capacity becomes a showstopper in every loan. So you have to always substantiate your loan document with evidences and proofs, with balance sheets or revenue projections, which will very clearly illustrate that you will be able to actually furnish all the EMIs on time with your projected income generated out of the funds invested in your business. So I hope this video is useful to you all, and looking forward to connect with you all in the next one.